Hey guys, Jared Wesley here of Live Traders, and it is that time of the week. It's lecture time. This week's topic, guys, is on market bias, how to develop a market bias each morning to help make your trading day a little bit easier, as well as breaking down a chart. So it's twofold once again. So market bias, guys, we're gonna look at the Qs and the SPY and how you can develop a long or a short or a neutral or a choppy bias each day. I've been getting a lot of questions about my ideas that I put out there on StockTwits at Scoutmaster if you want to check me out on StockTwits. But nonetheless, why I come up with those ideas and why certain ideas are long even though the market might be gapping down, or why certain ideas are short even though the market might be gapping up. So we're going to talk about that topic today, as well as breaking down a chart. Okay, I take a sell setup specifically on a chart and we break it down, why it's a good sell setup, why it might not be a good sell setup, and we take some of the future information and hide it, put it over top of the chart and go bar by bar, talking about topping tails, doji bars, narrow body bars, declining moving averages, resistance, support, etc., levels of retracement. So we kind of put it all together so we can in detail read the chart so that you guys can get a better understanding in real time whether or not it's a good pattern or a bad pattern. I think it's very, very useful for you guys to be doing this, not only because it will help you in your real-time trading, but because we want to get to that point, and I talk about at the end of the video, of unconscious competence, where you get so good at something you don't even think about it, you just do it, like breathing, like walking, etc., and so forth. There are too many folks out there that you're thinking way too much in the trading day. You need to get to the point where it's automatic. It's automatic. You're so good at looking at a chart, you're so good at it that you don't even think about doing it. And that comes through practice. So we're gonna break down a chart today. I put it in 4 different parts so you can kind of see the progression, the transition of the chart, and you have a better understanding of how to handle those things in your own trading in the future. All right, so we're gonna get to the video here in just a second. As always, guys, if you would like to get a $1 trial to the chat room, 14 days for $1 stinking dollar, the link is in the description. Click on it. You don't wanna miss that opportunity. We do a lot of stuff, including these lectures, and you can ask tons of questions in the chat room. Also, if you like this video, click the like button, guys. All right, like I said last week, there's no fluff here, guys, all right? We're just talking about hardcore, straight up trading. That's it. Not trying to sell it, just talking about straight up hardcore trading, things that can make you a better trader. If you like the videos, then smash that subscribe button. Hit that subscribe button, all right? I'd appreciate it. Anyway, nonetheless, let's get to the video, guys. All right, guys, it is lecture time. This week's topic is market bias and reading charts. Learn when it's okay to go long and short. So getting a lot of interesting comments in the chat room about stocks that are up a lot or about a market gap here or there. So you guys don't see all of the comments sometimes because some people will send me a private message. And so I want to talk a little bit about market gaps and how we develop a market bias and how you enter the trading day with that market bias, because sometimes people are thinking markets in a downtrend means you can only go short, and we're going to talk about that. But as always, because it's getting fun to do so, and I'm going to do it every single week until people stop sending them to me, all right? It's called When Will the Insanity Stop? So this week we have 3 or 4 people that have joined the Officially Insane Club. All right, and this is not meant to be a joke, as fun as it is for me to talk about this. This is serious stuff, and that's why I bring these slides up, because this really is serious stuff. So this was an email sent to me this past week. Yeah, probably earlier this week. What's today? Wednesday? So Monday or something like that. Jared, thanks for getting back to me so quickly, blah, 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 blah. None of that's important. I didn't highlight it in pink, but nonetheless, given the fact that I just completely effed myself under the PDT and CTSO, I don't know my trading platform well enough to get in and out of things quickly. This is paramount to where we're going with this. I don't know my trading platform well enough to get in and out of things quickly. So let's just skip ahead. So now I'm sitting on 3,000 shares with a cost basis of 903. And as of last night, and it might be higher today because I haven't checked, CTSO is sitting at 771. Now, I want you to tie these two things together. I don't know my platform well enough to get in and out of things quickly, and then down to the bottom where it says I have 3,000 shares of this. What in the world are you doing? Okay? These things, like, they also say common sense is so uncommon, it's a superpower. It is, okay? So granted, maybe it's bounced from 770 back to 825, but you're 3,000 shares. I mean, at one point you were down $4,000 on this, and you're a new trader with no education. Thankfully, this trader did decide to get an education, but the point I'm making is you shouldn't be in the position to do this. I understand this person made a mistake, but they told me, because I communicated with this person, that they were taking 1,000 share lots. 1,000 share lots. Why aren't you taking 10 share lots, 20 share lots, 50 share lots? Why 1,000 shares of a stock that's really whippy? Just learn from this, guys. This is just unacceptable. To be down $4,000 when you're new, it's unacceptable. And honestly, maybe CTSO comes back to 9 and you luck out, and maybe it goes down to 5, and then what? You eventually get out when the pain is so great you can't take it anymore, right? That's typically what happens. Okay, so let's move on from this, because this is just something, unfortunately, that a lot of brand new traders do, and you shouldn't be doing it. So here's the next one. There's 3 on this page. Okay, this is from our chat room, and everyone were hoping this person was joking, but I'm not so sure. I hid their name, but I have a short position on Tesla at 543, wondering if I should hold it. This was Tesla the day of the person mentioning their short position. Okay. This was Tesla, which was yesterday. This is when this person mentioned this. Beautiful 3-bar play, by the way. Wasn't it? Really nice 3-bar play, but that's not what we're talking about. This is Tesla on the day this person is holding at 543 short. And guess what Tesla did today? Gapped up today, right? This morning, Tesla gapped up again despite the market being down 2-3%. What are you doing? This hurts, whether it's 100 shares, 1,000 shares. There's rumors person at 1,000. I don't know, but that's just, again, come on, man. Right? I need that little Chris Carter episode. Come on, man. Right? So just be smart, guys. Here's one. This is another good one. Okay? On the right-hand side. Okay? This person's down $19,000 on Tesla. Different person, by the way. Different person. Okay? This is the largest loss I experienced in my trading career. I didn't write this. This person actually wrote this. They actually posted this on social media. Okay? I should have cut my losses, but I held out on the position and eventually took an almost 99% loss. Guys, I'm not going to drag these out every week. They're going to get shorter and shorter each week that I talk about the insanity. But it takes you guys years to save up $10, $20, $50, $100,000 to decide to be a trader and to do this business. And then in one trade, in 3 hours, or in 1 day or 2 days, you've given back 2 years of your hard-earned money. Really, I want you to internalize what I just said. In 1 day or 2 days or 2 hours, you've given back years of your hard-earned money because of stupidity. And this is why this business is so hard, because nobody's looking over your shoulder telling you not to do it. I said it today in the chat room to you guys. If you guys did this stuff at a normal job, you'd be fired the very first day you started. For as many mistakes as most traders make in one given trading day, you would be fired the very same day. And like I said, they wouldn't walk you out the door. They'd run you to the door. Get out of here. Most of you need a boss, and that's why trading is so tough. You're just very poor self-managers, okay? And last, and this one in some ways takes the cake, because this is from a... Let me clear my throat. I apologize. I got something caught there. A reputable trading firm. All right? Quote, unquote, reputable trading firm. And this is the answer to the question. I don't usually set a hard stop with the size I'm using. I'm able to have a wider stop to account for more swing in price. Thanks for the comment. I don't usually set a hard stop. So this basically went below the stop the person was talking about in their YouTube video, and they didn't take the stop. They just kind of let it go. So now you wonder, the people teaching this stuff let it go below their stop losses. Why wouldn't the people listening do the same thing? That's what they do, right? So you're unfortunately getting a lot of bad news out there in the world, or bad ways to trade, bad habits to trade that help you blow up your account. This particular one just happens to rhyme with American Ninja, and I don't know if you've ever seen that show, but anyway, it's just something along those lines. But I don't usually set a hard stop. Screw that. You know what I mean? My platform, my internet could drop out. Nah, that never happens. Wink, wink. It could freeze you with all the volatility in the markets. No, that never happens. Has anyone ever had their platform freeze in the last month? I have. Okay, but you're too good for that. No need to set a hard stop, right? The power could go out, the internet could drop, your computer could do an update in the middle of the day. It's happened to me, sadly enough, but hey, it is what it is. You're perfect. You don't need to do that. You're God's special child. All right, let's move on from the insanity and get into the good stuff. Okay, the lesson to be learned here is it takes a long time to save up this kind of money to start a trading business. Don't give it back to the market, guys, by being foolish and stupid. Use your stop losses. Have good money management. Plain and simple. Never lose more than $10 on a trade if you're new. I want to clear up one last thing before I move forward. Some people think that I'm condoning trading 1% risk. That is not what I said. What I said is new traders who are not yet profitable or very small profitably, if that's even a word, should be trading $10 risk. If you are an experienced trader and you have years of profitability, you can trade a maximum of 1% risk. There's a difference, a maximum of 1% risk. New traders don't get to do that. I got 4 emails on that same comment yesterday and it blew me away. You're not paying attention. Pay attention. All right? All right, here we go. Understanding market bias. Let's dig in. Okay, let's get straight to it. See, guys, I took this slide, I clipped it directly from Professional Trading Strategies. This is the only slide today that's directly out of the book. This is easy stuff. All right, this is the stuff that's no-brainer type stuff. Okay, the daily stock gaps up over a red bar, over a consolidation, right? A little pivot resistance, overhead supply over a red bar and breaks out. Good stuff. Oh, market gaps up and rips higher. Oh, here's a 3-bar play. Like, this is easy stuff. A novice person who's new to trading could probably get this, right? So gapping over a red bar, shock value. Stock's already in a short-term uptrend. We have a correction through time, which is a consolidation. Okay, and once you break over that $36 range, okay, give or take, the stock is off to the races, okay? Then you get a beautiful 3-bar play, and in this case, the market is moving up. Like I said, that's the easy stuff. Okay. The question is, what about when it's not this easy? And we've seen a lot of that lately. When the market has an inside day or the market's in a range, choppiness, then what? Because this is the days where everything goes right and you make 5R and you're up 5-10 grand, whatever. You make a ton of money. Okay. But what about this? I chose these two on the SPY and the Qs specifically because I've gotten some questions from people about my market bias on certain days. Every morning, right, we go over our gap list around 9:05 and I go over those 5, 10, 15 ideas. But before we do that, I look at the SPY and the Qs and we talk about what we think the market's going to do. Today's market bias, for example, was a short-term pop in the first 5 to 10 minutes of the day and then a pullback. Okay, and that's what happened, and now we're just kind of consolidating at the lows. But what about this? Okay, so I discussed this chart with a couple traders, all right, and they were a little confused. They're saying, wait a second, Jared, the SPY in this picture and the Qs in this picture are clearly in a downtrend. And I would agree with this, right? Lower highs, lower lows, lower highs, lower lows, and they are in a downtrend. But this gap right here was the source of contention. They're like, why did you have a bullish bias on this day? And I said, because it's a bullish day. And that's where you guys are messing up, okay? We have to talk about expectation. Are you scalp trading, micro trading? Are you short-term day trading? Are you all-day trading, meaning from 9:30 to 4 p.m.? If you are doing any one of those three things, this is a bullish day,
Why is it a bullish day? Because you're gapping more than 50% into a wide range red bar. They call this a gap surprise. So all the people that shorted the market or shorted those stocks yesterday are surprised when they woke up today that they didn't get a gap down. It's called a gap surprise. So some people are going, but we're in a downtrend. But we're not swing trading. We're intraday trading. And for the intraday bias, it should be long because of the shock value. You just took out 50 or 60% of yesterday's people that shorted the market. They're going to have to cover those positions, and it's going to help push the market higher. And you've heard the term, a rising tide lifts all boats. Well, most likely 70+% of the stocks on a day like this, maybe higher, are going to be long plays. They're going to be bullish. So yes, the trend of the market is lower here. Would I really be interested in swing trading long in this environment? Probably not. Would I want to core trade long in this environment? Probably not. Okay? But if we are taking trades that we're in for 30 minutes or an hour or 2 hours, and my bias from 9:30 to 4 is long, what is wrong with going long on this? The market is going to go higher today. We are going to have a long bias. So I just wanted to clear that up with you guys. A lot of people think, well, we're in a downtrend on the higher time frame. And you always tell us, Jared, what is on the higher time frame, don't buck the trend. The trend is your friend, that garbage saying, right? That is true for longer term trades. But we're not in longer term trades. So on this specific day, bullish bias. Now let's take a look. Okay? I broke this down for you guys. All right, there's two charts I'm going to show you on this. All right? Oh, where did that circle go? Oh, I took it off. Anyway, there's supposed to be a little circle right here. I apologize, right? It's supposed to be circled. Anyway, this right there is the gap down, okay? That's the daily chart of AAL, gapping down. It's down like 3 days here, but it has room to $10, okay? This is what I call micro market timing. It's probably a term you've never heard. Micro market timing. So in this case, what do we have? A market, let's take a look at the Qs, that actually gapped up, right? They gapped from 185 to 187 and moved a little higher. But notice on the first 2-minute bar of the day in the Qs, we were green. We went from 187 to 188 in the first 2 minutes. During that 2-minute period, what did AAL do? AAL did the exact opposite of the market. Right? So in this case, you're going to have a little bit of a neutral, bullish neutral bias. You're gapping over some green, but you have room back up to 190.50. So your market bias on this day will be basically kind of bullish neutral. Why? Because it's an inside day. You're between yesterday's low and yesterday's high. So it's typically a choppy day. We'll talk about this more in a second. So my point is, when the market moved higher, this stock moved lower. I immediately see, wow, I have relative weakness. I understand it's only 2 minutes into the day, which makes it slightly more aggressive, right? Because it's only a 2-minute chart. Anytime you're trading a 1 or a 2-minute chart in the first 5 or 10 minutes of the day, it's going to be more aggressive. But as long as you know what the expectation is, the expectation is for us to get a quick scalp trade, right? So in this case, I see this green, and I see this red, and then I see a topping tail come in. And then I see a doji bar come in, narrow range resting bar. Now I have my what? My bearish 3-bar play. And the market's putting in multiple topping tails. Those topping tails are suggesting we're going to get a pullback. How much of a pullback? I don't know. But the stock has enough relative weakness that I should be able to sneak at least a 5 or 10 minute trade out of this. So we got the gap down. It looks good. We have the relative weakness with a 3-bar play pattern, and then the market puts in topping tails and pulls back. So I call this micro market timing because ultimately the market went higher. And ultimately AAL, after pulling back, went higher as well. So we got in at 13 with a stop at 13.17, and this is what it looked like. All right, and just to be clear, what also helped me with the 3-bar play? All right, what also helped me with the 3-bar play was this pre-market at $13. See that pre-market chart at 13? Note, this is 4 minutes before the market opened. 4 minutes before the market opened. AAL under 13. Posted in the chat room, posted on StockTwits. There it is in the chat room. 2 minutes into the day. Guys, we're watching AL under 13. So in this case, we used what? The micro market timing, where we saw relative weakness on the first bar, topping tail on the second bar, and a nice what? 3-bar play. We got in right where we were supposed to at 13 with a stop at 13.17, and this thing tanked. I mean, this thing went down like over $1, which is a lot for a 17-cent stop. Okay? That's how it happens. Now, let's move to this. This is a 15-minute chart of the Qs, as you can see from not that long ago, a couple weeks ago. Now, what do we have? We have a range here, right? We have support at the bottom at 165. We have resistance at the top at 185. So the market for 1, 2, 3, 4, 5, 6, 7 days was in what? A range. 7-day range. And we call these inside days for the most part, right? When this technically is not an inside day here, but when you are between yesterday's low and yesterday's high, that's an inside day. And there is a couple of them in here. So now you ask yourself, the market gapped up, but, big but, what kind of a day is this going to be? So some of you immediately just look at the market green as, oh, it's bullish today. I'm going to repeat that because I think it should be. Oh, the market's green today on the gap up. The market's up 1%. The market's up 0.5%. It's a bullish day. No, it's not. Why does, just because the market green, does it have to be a bullish day? Or just because the market is red, it has to be a bearish day? You have to put everything in context. So a chart in a vacuum is worthless, right? We talk about context all the time, where we have multiple concepts converging in an area. So we see a gap up from roughly 170, 171, something like that, all the way up to right around 180. That's where the market opened, at 180. But look what's right above us. I mean, not very far above us, 182 to 185. Right here, there's a pivot. Right here, there's a pivot. There's a pivot. We have a mountain of resistance. There's overhead supply oozing out of this chart. Okay? What happened here? Sellers came in, stock dropped, or the market dropped. Sellers, market dropped. Sellers, market dropped. Sellers, market dropped. So if we're gapping right into overhead supply, my bias is going to be either neutral or bearish. In this case, the market ended up being pretty neutral, right? For most of the day, except for maybe the last hour and a half, the market was relatively neutral. It went up, it went down, it went up, but it stayed in a range, right? It stayed in a range. So what kind of day are we expecting? Narrow range and choppy. These are the days most of you guys are getting killed. You're getting crushed because generally speaking, there's a general lack of follow through in the markets on these kind of days, right? There's a general lack of follow through in the market on these kind of days. So you go into a day where you're butting your head up against resistance and you're going long on everything, and what's happening? You're getting chopped around, slopped around, because the market doesn't have a lot of room to go anywhere, okay? So you can't have high expectations on a day like this. You can't come into quadruple top resistance and expect the market just to slice through it like a hot knife through butter. It doesn't work that way, okay? On the downside, you have actually room to fall here, right? If you open at 180, you have room to fall into 175. This is a tough day. So on days like this, what do? We do this, right? We look for these types of things, because this is what I call a good anytime trade. This is a good trade no matter what the market is doing, okay? Why? Because this stock is gapping under a prior pivot, right? It was looking bullish. It was putting in some higher highs and higher lows. It pulled back. It bounced. It's triggering a pseudo buy setup over here. And then boom, you wake up and it gaps under the bottoming tail. So there's some shock value. Under green bars, under a bottoming tail, smooth move up means a smooth move back to 55. You look at the 60-minute chart, you can see tested once, tested twice, tested 3 times right there in that, what is that, $63 range, give or take, and then today it gaps below it. So this is our tradable void. Now, it doesn't look like much, but it's $2, right? It's $2. So I look at this gap and I go, you know what? On an inside day in the market, I want to find something that's truly weak or truly strong, like really on its own page, relative strength or relative weakness. Okay, so this qualifies. Nice gap, void below, relative weakness on that particular day, and it had a nice pattern. The pattern was a 1 minute breakdown at 62.50. Okay, so you're in at 62.50, your stop 62.70, and ultimately went to 61. Okay, and notice where it basically stalled. Yeah, it went peekabooed under a little bit, but it stalled right at that support area. Okay, so that was the tradable void. Now, these are what I like to say. Anytime trades. This is a good enough trade you can take just about any time because the gap is nice with shock value. It has void to drop. It has relative weakness to the market. It has a really good pattern, right? This is a pattern that you feel good about no matter what the market's doing. That doesn't mean it's going to work 100% of the time. It just simply means it's a very high odds trade regardless of the market, right? High odds trade regardless of the market, okay? So next is reading a chart in context, okay? Reading a chart in context. We talked about this last week, okay? And real quick, guys, I told you I'd bring it up for a second. We went to 72.62 on this. Our target on this, guys, right now is 72.30, okay? So hopefully we'll get down to 72.30. Our stop is basically break even on this. Okay, and hopefully we'll get this thing down to that 72.30 area. All right, all right. So why didn't that go up? There we go. So I talked about this last week, okay, in terms of what people think. Now, what I want to do today is talk a little bit about individual stocks and how you can apply this thought process to the trades that you take. Okay, so I made a joke out of this because somebody else, Dr. Jean-Paul Rodriguez, is the one who put this up. I'm the one who put all the little pictures in here just for having fun, okay? But it really is true. Most people are on the wrong side of the market. Most people. Why? Because they need too much confirmation, because they lack any skill or understanding of the market, okay? But we're going to take this and we're going to apply it to one, maybe two charts today, okay? So first and foremost, this is what that looks like. This slide was in there last week too, in an actual chart. Now, it doesn't matter if this is a 1 minute. It doesn't matter if this is a weekly. It just doesn't matter. Okay, so we're in a downtrend. We double bottom. We break the trend line. We have a buy set up here, a buy set up here. Great. All right, so this is what that stage 1 through stage 4 looks like, right, on an actual chart. Now I want to look at it in I don't want to call it real time because it's not technically real time. But we're going to do something that you should all be doing all of the time for either every trade you take or every trade review that you do. Take a look. Notice what I've done here before we even talk about the chart. I took a big blue box and I covered the future. Okay? Now, granted, you can go as far left as you want to go, but I want to cover the future because I want you guys making decisions as if it's actually happening, right? Try to be as realistic as you can be so that when you're studying and you're reviewing, it's as if the market is actually open, okay? So we look at this right here, and we have a stock that's on a 5-minute chart, and it's in a downtrend. Lower high and a lower low, and a lower high and a lower low. 2 lower highs and 2 lower lows equals a downtrend. You're below the declining moving average. So what do we have? Good, solid 5-minute sell setup. It's in a downtrend. Check, good. It's got higher lows, good. It's got lower highs, good. It's good retracement level. What do I mean by retracement level? Well, the prior pivot high is like 38.88, okay? This is down here at like 38.53. So we have about 35 cents from the top up here to the bottom. This is in the like 38.68 range. So it's about a 40 or 50% retracement, about a 40% retracement. I think 38.70 would kind of be in the middle. That's exactly what we're looking for, guys. 40, 50, 60%, that 40 to 60% range, 50% range on the retracement. Okay? I want you to think about it. If this thing retraces too much, what does that tell us? When I mean retracement, I mean back up. If this stock goes back up to 38.85, what does that tell us? The buyers are stronger than we thought. Right? It's bullish. We don't want the buyers to be strong. We're trying to short this stock. We want it to go lower, so we don't want the buyers to be strong. If it doesn't retrace very much, say it only retraces 10%, it probably hasn't rested long enough. So we want to find somewhere in the middle. Too much retracement, it questions the weakness of the stock and actually makes us think it could be bullish. Too little retracement, and we think the stock hasn't rested long enough and it could fail. So if we're somewhere in the middle, that's a good thing. Okay, we have a green bar ignored. That means this green bar right here was completely ignored by this red bar. We're taking out all of the buyers here. There was a tug of war. There was a battle that was fought, and the sellers won the battle. Well, if we want to short the stock, I want the sellers to be winning, not the buyers. This confirms that. It's just a confirmation of weakness. That's another check mark for the goodness of this sell setup. It's below the declining moving average. That's another thing. Okay? So all of these things are positive reasons to want to trade this stock at 38.60 or 38.59. Okay? All of those things. The only concern here really is possibly the risk to reward. It does not have a great risk to reward, about 7 cents to the low of the day on an 8 or 9 cent stop. So you barely have 1-to-1 to the low of the day. That would be a bit of a concern, right? That's a little bit of a concern. Okay, but the question then becomes, does the goodness outweigh the concern? Possibly. So our expectation here, all right, the expectation here is that this stock, because of all of the positive attributes, should put in a new low. I'll repeat that. It should put in a new low. And guess what? It does. Puts in a new low. Okay? So far, this is a pretty good sell setup. Okay? This is a pretty good sell setup. Okay? So now, next slide. We've covered the future. Guys, I left these on here on purpose. Obviously, I could have covered the whole damn thing, but I left it on there on purpose. All right? So now let's move to the future. All right? Now we have a little more information. We took the first sell setup, right? We took the first sell setup. So now the question is this a good sell setup? Is the second sell setup a good sell setup? And what is our expectation here? So we're still in a downtrend. That's good. Lower high, lower low, lower high, lower low, lower high, lower low. We're still in a downtrend. Positive number one. Higher lows and lower highs are positives, both of those, right? That's our little bounce we're looking for. Topping tail, that's a bearish sign, right? Sellers creeped into this and pushed it lower, meaning at one point in time, let me repeat this, at one point in time, this bar was green right here. This was a green bar right there. But then sellers came in, leaving a topping tail and a red bar. Okay? So we have a changing of color bar from green to red. We have a topping tail. Good. Below the declining 20. Good. We have a lot of goodness here. But what do we have that's a concern? Okay? This should not be there. Let's, boom. See that? Look at that. Real-time fixes. Retracement level is what? Back to the prior pivot high at what? 38.67. Okay? So we're taking a look at 38.43 to 38.67. It's about a 23, 24 cent move. And we've retraced to the 38.64 range, 63. This retracement level is somewhere in the what? 80% range? 90%, 80% range? So we have to be concerned here. Are we at level 2 resistance? No, we're not. Level 2 resistance is down here. So we have three location items. We have a moving average, we have the retracement level, and we have the prior pivot low. Prior pivot. Those are the location items. They're very important. We only have one of the three. So that begs the question. What is the expectation? And can we take this trade short? Well, it's a good question. We can take the trade short if what? Anybody want to take a shot at it? We could take this trade short if what? I'm going to give you a hint. It has to do with expectation. Okay, you're allowed to take it if your expectation is proper. So what should the expectation be? For this. Somebody's saying if we expect it to put in a new low, it's the opposite. If your expectation is for this stock not to put in a new low, to put in a higher low, then you could try to scalp this. If your expectation is for the stock not to put in a new low, okay, then you could scalp this from 38.57 down to say 38.50. You're probably going to get a pullback here. You will. You'll get some type of a pullback, but it's not likely to put in a new low because the retracement level's 80%. It shows buyers are starting to creep in here. If this stock was truly as weak as we thought it was, it would have stopped at 38.55 and not gone to 38.63. It wouldn't have gone up here. It would have stopped down here and sellers would have came in. They would have dominated the buyers and it would have pushed it lower sooner. But they didn't. So the expectation here is not to put in a new low. Not to put in a new low. So this, in a way, would be a bad spot to add to your first trade because you're not going to put in a new low. If you want to scalp it, probably you could get away with it. Let's move on. Same chart. We're just going to see a little more of it. What happened? Put in an equal low, slightly lower low, right? That's what you expect, a higher low or an equal low. That is the expectation coming from an 80% move. That's the expectation. In this case, it went a little further than I would have expected it to go. I would have expected, like I said, 38.50, 38.47, something like that. But hey, at least it put in an equal low, slightly lower low. Bounces back up. Now what? Okay. Downtrend. Yup, we're still putting in what? Lower highs, lower lows on the pivots. Good retracement level. This one's borderline, right? This one's borderline. Okay. So you're looking at the top at 38.63. You're looking at the bottom at 38.42. So what? 21 cents. And this is at 38.55. So you're maybe in the 60% range. You're right at the moving average here. That's good. So that's positive. Retracement level is probably right there. Borderline. Okay. Borderline. But significant new prior low. Nope. Now you have a double bottom. Do you guys see what's happening here? Give me the word for what's happening here. Give me the word. There's a one-word answer to this. You could say one of two things. Either you could say this is a reversal happening or about to happen, or you could say this is transition. Reversal, transition, it's the same thing. Accumulation is happening, Constantine, that is correct. But we're either I'm looking for either reversal or transition. Meaning, we're looking to transition from a stage 4 downtrend back to a short-term stage 1, perhaps W bottom, into a possible early stage 2 uptrend. Okay? So, yeah, no, this is not a 3-bar play. Anyway, the point here is that this is not really a good sell setup. This one was borderline because of the 80% retracement. We talked about a potential scalp. This not so much because now you're shorting into a double bottom support area and you can see the momentum is slowing down. We are no longer putting in significant new lows. Momentum slowing usually means reversal at some point. What happens? The reversal happens. The stock puts in a higher low and a higher high, and basically the move is over. Does that mean, just because there's a reversal, does that mean we're going to go back to $39? No. It doesn't mean we're going to go back to $39. It just means the move lower is finished, right? The move down is done. It's over. Double bottom, triple bottom, higher high now. So now I have an equal low followed by a higher low and a higher high. So is it really surprising that a new low was not set? No. No, it's not surprising. This is what's expected, right? We expected this to not put in a new low. We broke each one of these down. And the reason I'm commenting, going so detailed and specific on this is I get these questions all the time from people. Hey, Jared, check out the sell setup on XYZ. And I'm like, did you look to the left? There's a triple bottom right there, a double bottom right there. There's an 80% retracement right there. Yeah, I know, but stock looks weak. but the chart suggests the low has been set. This doesn't work 100% of the time. Sometimes it puts in a new low. But most of the time, you'll be better off not taking this sell setup. Now, the next question is going to be this. I'm going to just answer it before you even ask it. Hey, does that mean we can buy it down here, Jared, at 38.45? No. It's too aggressive. It's too aggressive. Until you get out of this choppy area right here, don't touch it. You don't need to be the first person in. Let the stock bounce. Let it come back. Remember this chart? Hold on, where is it? Right, this one. You don't need to get in here on this breakout at $20. Look how many other patterns you had the opportunity to get. A beautiful buy setup that put in a higher low and a higher high. Another buy setup that put in another higher high and another higher. You don't need to be the person in down here. That's very, very aggressive. And once in a while, you'll be right. And you'll see, I told you so. But you don't need to be that aggressive. It goes back to new traders risking too much money. Why? You don't need to be that aggressive when you're new. You're not that good when you're new. You're not that good at reading this bottom and buying it right off the bottom. Wait for the confirmation, and you're still getting in near the bottom. If you took this buy setup at 21 bucks, this thing went to 50. I think that's a pretty good trade, right? Pretty good trade. So now the question I have for you guys in general, it's rhetorical, so you don't have to answer it, is how often when you're studying your charts do you do this? How often do you do this? And go bar by bar by bar by bar and read the chart bar by bar without knowing the future? Probably not very often. Put a piece of paper over your chart. Put something over the future so that you can just go through it bar by bar. Guys, you've heard the term hindsight's 2020. It's like I've never met a losing paper trader. Well, I've never met a losing hindsight trader either. Okay? So my point is this is a valuable teaching tool, not just going through the chart the way we did, but putting the future, blacking it out, blocking it out. Okay? I think it will help you significantly. Okay? Now, last big chart of the day. All right? Going to be a little shorter this week. Let's walk through this chart, what's good and what's bad. This is not the same chart. It's a different chart. Same concept in that it's a sell setup. Okay, so I put these as entries here and here. Let's walk through it and talk through it and find out what's good and what's bad about this. So first and foremost, gap down under what appears to be some support to the left. I don't have much more information, so in this case, we're going to have to trade this one in a vacuum. It's not a good idea to do normally, but for this lesson purpose, we're trading in a vacuum. So we gap down. We're under support. That's positive. We're under the moving average. That's positive. If you're looking for this stock to be bearish and possibly short it, we're under the moving average, we're under support. Good. It drops, okay? Bounces back up. So if we look at the high here and the low here, that's about a 50% retracement, maybe 60. So the retracement level is good. We are under the moving average. That's good, okay? We don't have any level 2 resistance to the left or minor price resistance to the left. So we have 2 out of 3 on the locations. Then what? Well, we have a doji bar. We also have a topping tail bar next to it. Guys, what are these things telling us? Remember I did a lecture a few months back now about bars, what bars mean, and they mean nothing by themselves, but in the context of the chart, they mean everything. Well, this green bar means a lot. It's the first time in a 10 or 15 minute period that the buyers were able to overcome the sellers. That's a little bullish. Then we have a bottoming tail bar, okay? And we have a bottoming tail bar. It's bullish, okay? Another green bar, bullish. But now take a look. We also have a green bar right here, but that green bar left a topping tail. This was a wide range green bar at one point, but then it pulls back and leaves a topping tail. Next to the topping tail bar is a doji bar. What does this represent? It represents a tug of war. There's no clear winner here. The buyers didn't win, the sellers didn't win. But guess what we're leaning? Remember, in the context of the overall trend. What does this doji bar really mean? It really means bearishness. I understand it's green, and I understand you could argue it's a coin flip, who's in control, but look at the context. Up 4 green bars on a 50% retracement in an overall bearish move. I'm leaning towards the sellers, despite this being a slightly green bar. Okay? So doji bar on a 50 to 60% retracement after a topping tail means you're likely going to get a pullback soon. So you're going to look to short it under the bottom right there. See that little bottoming tail there? You're going to short it under there. You're going to put your stop up right here. Okay, right there, like 552, 552.50. Your entry is like 549. So you're like a $3.50 stop loss. Your target's down here at like 543-ish or something like that. So do you have, or sorry, yeah, that's about right. So you have about what? $13, $14 to play with, more than that. So you have plenty of risk to reward, right? You have about $10 to $15 to play with on a $3 to $4 stop loss. So your first target area would be down here. My point is, do you see how we walked through this? We walked through it and we talked about, before we even got to the pattern, we talked about, does it even look good up here? It's under support, it's under the moving average, and then it shows weakness. Good. The retracement level was nice. It's under the moving average. It had a topping tail. It had a narrow body bar, okay? It had a topping tail doji bar. It has good risk to reward. Drops, puts in what I would consider to be a significant new low. That's clearly a lower low. Clearly a lower low. Bounces back up, kind of near what? Overhead supply, minor price resistance, level 2 resistance. But the negative here is now I have a bottoming tail. That's not a good sign, but it got engulfed by the red bar. Okay, we're a little bit far below the moving average. So this one is tougher. It's not as good as the first one, okay? So could you argue to take it? You could, and you're going to have about a $3 stop loss, and your risk to reward's not as good. You have about a 1.5 to 1, okay? 1.5 to 1 here. So I'm not saying you can't take it, but it doesn't have as many positive attributes as the first one did. So I don't know if I would add here. If I took the first one, I'm not sure I would add down here. This is a tough one, right? You're already down $15 on the stock, $16 on the stock. How much more can we expect? So I would lean towards probably not taking this. But if you did take it, I wouldn't say it was a bad trade. Just my expectation is going to be a little bit lower on this. Okay? Now, one more quick thing I want to talk about, and this is going to help transition into the next week or two's lecture. I haven't decided entirely on next week's lecture, but I think I have an idea. And if it's not next week, it'll be the week after. I wish BYND would go lower, but oh well. All right, so this next slide I want you guys to think about for a second because it relates to everything we just did, okay? These are called levels of understanding. Unconscious incompetence, conscious incompetence, conscious competence, and unconscious competence. Now, why am I bringing this up? We just broke down that chart, 2 charts, really in detail, especially the one chart, right? What we did there over a 20-minute period should be happening in your head in 1 to 2 seconds. That is when you've reached unconscious competence. You know it so well, you don't think about it. Name one thing you do in life where you're unconsciously competent at it. Okay, other than taking bad trades. A lot of you guys are unconsciously competent at taking bad trades. Name me one thing. Breathe. Great. It's true. You don't even think about it. You just do it. All right? Drive a bike or ride a bike. For most people, not everybody. I've seen some bad, but most people. Yep. Pee. Okay. I guess that's true. Walking. Walking is another good one. Right? They're the 2 ones. It seems like everybody's probably on the same page. Walking, breathing, you're unconsciously competent. You don't even think about it. It's just, it is. Okay? That is what a professional gets to. Okay? Professional gets to that level. Whether it's tennis, whether it's hockey, whatever it is. Many of you guys you neither understand or know how to do something, nor recognizes the deficit or has a desire to address it. Okay? You just don't know. It's like you don't know what you don't know. You're in la la land. This is the ignorance is bliss area. Okay? Then you go down to conscious incompetence. Though you do not understand or how to do something or know how to do something, you do recognize the deficit without yet addressing it. This is where most people are. You have a recognition that you know you're not good, but you're not yet fixing it or addressing it. Then you get to the conscious competence. You understand or know how to do something. However, demonstrating the skill or knowledge requires a great deal of focus and you make mistakes. Most of you are stuck between these two areas, literally in the middle. The conscious incompetence, you understand there's a deficit, but yet you still do stupid stuff, right? That's what I call this, kind of like the idiot transition. You get it. You understand there's problems, but you still do stupid things, but you're working towards addressing those problems while you're still doing stupid stuff. And then the ultimate goal, obviously, is to get down. You've had so much practice with a skill that it becomes second nature and can be performed easily without concentrating or even thinking about it. So it goes back to these charts. We went over that chart 20 minutes. You're going to get to a point where you go through that chart in your brain in 1 second, 2 seconds. You're going to look at it and go, yep, okay. That fast. Oh yeah, it's a bottoming tail at minor price, 50% retracement with a topping tail and a narrow body bar, and the risk reward's great. Done. And your brain will just click it off. That is the area you need to get to. Why? Because then you're automatic. You don't waste time, especially if you trade the market open, right? Where 10 seconds, 20 seconds is a long time sometimes. So you don't have to think too much about it. Now, that won't be for every trade. We're human beings. We still make decisions. There are times we question ourselves at times. That's just being human. But most of the time, you'll be unconsciously competent. You just know what to do, when to do it, and how to do it. And that's when you know you're at the highest level of trading. A lot of people ask Anmol why he does what he does with regard to management, or why he uses that management. Because it's unconscious competence. He doesn't have to deal with it. It's like, all right, I know it works. You remember his video where you flipped a coin 50 times or 100 times? The odds are the odds. Sometimes it's 42%. Sometimes it's 61%. But it all works out in a Wall Street and it's out to 50%. It works. I'm not going to overthink it. Let it go. Okay, so quick recap. 2 topics outside of when will the insanity stop? I hope soon, guys. I really do, because watching people lose ridiculous amounts of money is sad. Okay. Next, reading the chart in context. Sorry, I skipped a section there. Understanding the market bias. Okay. And that means knowing when the market looks like crap. When you're in a narrow range, like we looked at the 15-minute chart of the Qs and we're stuck in a range, knowing what your expectation is for a day like that. Either sit on your hands and do nothing, or make sure you take a stock that's completely and utterly on its own page, and they are few and far between. For most traders, a day like this typically means not trading very much or not at all. Next was reading charts in context, right? And we went over this one chart basically over and over again, removing the blue box so we can see more information delving into the future. All right. I want you guys to be doing this so that you just be better chart readers, and then you'll ultimately get to the pinnacle. And the pinnacle is unconscious competence. All right. Hopefully you'll get to that point. It will take you years to get to that point. Okay. So that will do it for today's lecture. I hope you guys got a little bit out of that. Still in that BYND, guys, so we'll have to wait and see how that plays out. But anyway, that'll do it for this week's lecture. Hope you guys took something from it and can apply it to your trading so you'll be better traders. I'm Jared Wesley. I'll see you guys again next week.
To get more great educational content, subscribe to the Live Traders YouTube channel. This way you'll get email alerts every time I upload a new video.